Hello and welcome to Wealthion's Weekly Market Recap. I'm your host, Andrew Brill. I hope you had a nice and safe Independence Day holiday. Will the Fed cut interest rates in September? That was one question Peter Boockvar addressed when he joined Wealthion this week. He also spoke about the possibility of the market being in a bubble with stocks being overvalued, the state of low-income families and being budget conscious, and also gave us a hint about commodities being a good buy right now.
Peter, I want to start our conversation on the U.S. economy. The Q1 GDP was revised down from 1.6 to 1.3%. This implies a slowing economy. Walgreens recently announced that they're shutting down over 2,000 stores, and one of the reasons is because of the weakening consumer. And the CEO did state that he continues to see persistent pressures on the U.S. consumer. And we've heard the same sort of scenario coming out of Starbucks and also McDonald's. What are your thoughts on the U.S. economy? And maybe you can also share your thoughts on how you think the U.S. consumer is doing.
Yeah, the comments were widespread amongst all retailers and restaurants and anybody selling consumer products based on all the earnings calls that I've listened to over the past few months. One of the more sort of sad but interesting comments came from a company called Casey General Stores, which owns a bunch of convenience stores in the Midwest. They said the higher income consumer is doing fine when they pump gas or hop into their mini mart and buy stuff. But they gave an example of lower income consumers that are buying more fountain soda instead of buying bottles out of the fridge. To save money. I mean, you're talking about saving, what, 50 cents? Maybe. So that tells me just how value conscious and deal seeking a portion of the consumer population is. And it's not just low end, it's middle income. It's those that are making more than 100 grand, 150 grand that are now shopping at Walmart or going to Dollar General because they're looking for bargains. And in fact, Walmart at the Bank of America conference used the same word that I've heard from them, from the CFO there, for 2 to 3 quarters now, and was choiceful. And the consumer being, again, budget conscious and prioritizing their spend on needs more so than wants, on non-discretionary things more so than discretionary things. But all that said, we also had great numbers from Carnival saying that their earnings and their revenue and earnings and bookings and yield are at record highs, and they have pricing power. And business seems to be great because they're catering to both a budget consumer, for those that want to travel lower cost, but also baby boomers and other retirees that are benefiting from a higher stock market, 5% interest income on their savings. So it is a very bifurcated sort of 2-lane consumer highway that we're seeing. And I think that can be said for other parts of the economy too, reflecting overall a very mixed and uneven economic situation right now.
So now that inflation is at least heading toward the Fed's 2% target rate, the Fed had a meeting in June. They left rates unchanged. We have another one coming at the end of the month, I believe on the 31st. Do you think we'll see the Fed cut rates in this month?
They won't cut rates in July, but I'm beginning to think that they could cut in September because a few Fed speakers, including Powell at that press conference at his last meeting, did highlight the growing importance of them watching the labor market and the unemployment rate as something factoring into their debate on rates, where for the last couple of years we know it's been all about inflation. And if you start to see, 4% unemployment rate we know is historically low, but it just so happens to be a 2.5-year high. So if that all of a sudden starts to creep up ahead of that September meeting, 4.1, 4.2, 4.3, whatever it is, because we're also seeing lessening demand for labor in the continuing claims data, a pickup in firings in the initial claims data, job openings that are shrinking, that if you get a further increase in the unemployment rate here, I think the Fed might try to squeeze one in September. Now, they'll likely telegraph that at Jackson Hole in August, but I do think September is a growing possibility, whereas before, some commentary from like Mary Daly, for example, over the last couple of weeks, I was thinking, you know what, they don't want to even bother with the election. They don't even want to be perceived as being political. They're just going to wait till December. I think a 4.2, 4.3 unemployment rate is going to sort of pressure them to cut, but also couching that into some similar to the way the ECB did as a hawkish cut, that letting the markets know that this is not the beginning of a long string of rate cuts. But if it ended up being the beginning of a string of rate cuts, that would be because the economy is really rolling over. So I don't think we want to wish for that.
So it sounds like you have a big weighting toward commodities. You're long energy, uranium, and copper. What's your thesis there?
So copper, it's certainly a supply-demand story. We know the growing demand for copper is not no longer Chinese construction of apartment buildings. That it has obviously found some new use cases. Precious metals, silver is half the demand for silver is industrial, so there's some overlap there in terms of benefits that copper is deriving from, but also very much bullish on the monetary side of gold and silver, just because of the rising debts and deficits of the U.S., the growing central bank demand for metals, the growing demand in terms of trade outside of the U.S. dollar, like the Chinese buying oil from Saudi in renminbi, buying oil and natural gas from Russia in renminbi, buying corn and soybeans from Brazil and Argentina in renminbi, India buying oil from Saudi Arabia in rupee. To me, that's a very interesting dynamic where less dollars are getting recycled in U.S. Treasuries, and whatever's left over gets bought in the gold market. So to me, that's interesting. Ag has been beaten up, and we had owned like Mosaic and Nutrien, two fertilizer names, going into the Russian invasion, and we sold it on that spike. But both stocks have gotten cut in half since. So we've recently re-entered them. Believing that crop prices are cheap, and there's an opportunity here where you get a good dividend, cheap valuation, and believe that in this kind of environment, it's a pretty good opportunity, because I prefer looking at things through a value lens, and that's what attracts me to names like that.
We talked with Nick Colas of DataCheck Research about the recent presidential debate and what reaction markets might have. Nick also tried to explain why economists and market analysts see a completely different picture when it comes to the economy. And he explained how the debt hasn't yet affected the bond market. Now, Nick, I want to ask you, we talked to a lot of economists, and then we talked to a bunch of market evaluators like yourself, market analysts. And if you talk to an economist, it's gloom and doom. Recession is coming. Doesn't matter what you do. It's on its way. But when I talk to you as a market analyst, you're like, no, actually things are looking okay. Why is there such a discrepancy in the numbers or in the way people look at the numbers?
I think the biggest reason is that the stock market doesn't discount GDP. It discounts corporate earnings. And that's a big difference. So an economist can be pretty cautious on the economy, and I can totally understand why. Things are beginning to creep higher in unemployment, the labor market's weakening, growth is weakening, but corporations manage through those problems. They manage through in order to create higher earnings. That's just what they do. And so the stock market can work reasonably well, even if the recession is slowing and there's a risk of, the economy is slowing, there's a risk of a recession, because corporations are working to tighten the belts, cut costs, and generate earnings growth. And that's what stock markets discount. It's, GDP is interesting to the stock market, but it has no effect really on corporate earnings unless there's a big recession. And because of that, the stock market will look at earnings and cash flows and returns on capital and which businesses are doing best and shuffle capital off to those. And if it means, in the case of what we're having now, we have a handful of companies doing extremely well with very high earnings growth, extremely high return on capital, then those groups are going to work and drag the market higher.
We just got through the first presidential debate, and obviously earlier than we expected. Do you see a switch? We see the news, we read all about how each candidate did, and I won't get into that. But do you see a switch in different stocks that are sold off or bought because of what happened in the debate and what, who everybody thinks is going to be elected president?
I mean, there's some obvious sort of churn in names like the Donald Trump's SPAC. So on a single stock level, you absolutely do. At a broader market level, it's more of a macro dynamic. We were just in Europe visiting with a lot of institutional customers, and to a meeting, every single meeting, the first topic was the U.S. elections. Now, part of it's because we're a U.S.-based firm and the European investors want to hear our point of view, but it was very clear to me that a lot of them are just not going to invest a lot in the U.S. incrementally until the election is over. So it creates a bit of a freeze on global asset flows because they're very sensitive to economic and political disruptions. We saw that in the UK. We saw that in France. And they feel that the U.S., they'd rather just wait to see who wins, not just the presidency, but also Congress, before they make a lot of incremental investment decisions. So it could create a bit of a near-term freeze on global capital flows into U.S. stocks, simply because not that they're looking for bad news or worrying about what might happen. They just want to know what is going to happen. And that kind of uncertainty has a tendency to reduce investor interest. Haven't heard that as much from U.S. clients yet. They're still focused on, how do I beat the market in the third quarter? But it definitely, from a global perspective, I see that happening. It's a bit of an interesting dynamic where, again, they're not worried about one candidate winning over the other. They just want to know who's going to be in charge.
Let's talk about bonds and interest for a minute. The debt, Nick, is gone crazy, and it's going to cost us down the road. But obviously, lowering interest rates is going to help the debt rise slower, I guess, than it has been. How do we get out of this rut? And who is worrying about the debt? It seems that both these candidates will continue to spend. Our debt will continue to rise, and it's going to create an even bigger problem than it is now.
Yes, it's a super important dynamic. I make 2 points. The first is, what's really interesting about this latest round of incrementally much larger federal debt is that it hasn't yet really affected bond prices. So if you look at real yields, real ex-inflation yields over the last, call it 20 years, back to 2004, 5, 6, you'll find that real yields are no higher now than they were pre-financial crisis. They're running around 2%. So if you take inflation expectations of a little bit over 2 and real yields make the balance, you get to the 4.5% 10-year yield that we have now. So real yields are no higher than they were pre-financial crisis, when you think they would be, because pre-financial crisis, we were running 60% debt to GDP. Now we're doing 120 nominal. And yet yields are not reflecting any kind of incremental risk. We also see it in the corporate bond market. So again, you'd think that if people were worried about the federal debt, they might want to buy AAA, AA corporates because they're very safe and they're very well-run companies with great competitive advantages, great cash flows. And yet the spreads of AAAs, AAs, single A's over treasuries are just as the same level now as they were pre-financial crisis. So the market has not yet incorporated the federal debt problem that we all recognize into bond prices, because the dollar has remained the reserve currency. If the dollar is up, call it 34% since 2010 versus a basket of other currencies. So there's nothing yet triggering markets to acknowledge that the debt issue is a serious one, simply because the dollar is still the world's reserve currency, fiat currency. So we're not yet seeing the tension in markets that you would expect given these very large deficits. And that's both a good thing and a bad thing. The bad thing is it doesn't create any catalyst for change, which I think we would all agree the U.S. needs. On the positive side, it does maintain the government's ability to borrow, which is very important for economic growth. More broadly, the issue about the debt is, and again, this comes from conversations we have with a lot of European investors, they don't so much mind the debt because they feel the U.S. economy is better structured than any other major global economy. So the Swiss have a great economy, but it's very small. The U.S. has a very strong economy with a lot of innovation and a lot of growth and a lot of systematically important companies, and they see that as kind of the offset to higher federal debt levels. So yes, they would also like the debt to be lower. They think it's kind of unwise to issue so much debt. But they recognize that the money goes into the U.S. economy, which is still the best structured economy in the world, both in terms of its labor force flexibility and in terms of innovation. So we end up with a situation where, the debt is crazy, but at least it's going into the U.S. economy, which is by and large a better structured economy, both for the current and for the future, than anything else in the world. And issue with capital is it has to go somewhere. And so capital chooses destination, and it's still choosing the U.S. even with the debt, even in spite of the debt, because the other dynamics in the economy are so good.
We get asked all the time about cryptocurrencies, so Anthony Scaramucci turned to expert John D'Agostino of Coinbase to get his thoughts on how to avoid scams when it comes to purchasing cryptocurrencies. John also pointed out there is a lot of misinformation out there regarding crypto and how to educate the misinformed. He also said the story on the crypto ETF and halving has not yet played out.
To the extent you can comment on U.S. regulation. If you can't, that's fine, because I understand the situation with the company, but the extent you can comment generically on U.S. regulation, please do. If not, I'll go to another question.
I can comment generically because Coinbase puts out public statements on it. I mean, and I'll say my personal opinion, which I think aligns well with the overall corporate view. I believe that the average person who works at a U.S. regulator wants what's best for this country. I genuinely do. I know that's not very popular in crypto. There's this attempt to demonize the entire staff. I think that's wrong, and I don't think anyone from Coinbase has done that. I admire them for that. I think that it's scary for them, faced with a new technology and faced with the burden they have to protect markets. I think that they've gone astray in terms of the direction. I don't ascribe any malicious intent to that personally. I think that that bad way of governing is losing. I think it's clear that it's losing. It's losing in terms of the market is telling them that it will survive regardless of what they do. Overseas markets are saying we will gleefully bring this business in. One of the conversations I've had recently, which struck someone I think is fairly compelling at that level, was if you could go back in time 50, 75 years, if you had a time machine, go back in time and say, okay, and you can grab whoever's in charge at that point and say, hey, I know you guys don't think that computers are going to be a big deal, but just in case you're wrong, maybe it's not a great idea to have all semiconductor fabrication occur on a small island an arm's length from China. Like, just maybe we want to rethink this just in case this computer thing's not a fad. Virtually 100% of people say, yeah, that would probably have been a good idea. And so when you frame it that way, when I meet somebody who's bizarrely antagonistic to math, and that's really what it is. If you hate if you don't think Bitcoin's a good asset to buy or sell, to own, we can have an intelligent discussion about that. Not everyone believes in every asset. If you think that it's a Ponzi scheme, or you think that it's has a higher probability of fraud, you're either misinformed or you're using weaponized misinformation, which some people absolutely are. They're smarter than that. They're aware of what's going on. They choose to weaponize misinformation. Crypto as a tool for money laundering, for terrorism, it's a classic example of weaponized misinformation. We know demonstrably it's not true. So if you're faced with that, that type of misinformation, I think you either have to, again, if it's the first type of misinformation where someone's just genuinely unaware, you educate them. If you're faced with weaponized misinformation, you have to just fight back through either litigation or through the political means or through public appeals. And I think the industry is doing that very well. And so I think the industry is winning overall. I'm disappointed in the reaction. I think if regulators, when seeing that the markets are demanding something and seeing that they're working, I think they should, in the face of that information, reevaluate their position. That doesn't seem to be happening here. So that's disappointing. But I'm very, very confident that the smart, good people at these regulators will continue to do their work. And then over time, we'll see the U.S. gain back prominence in this sector.
I'm going to push this narrative on you and just test you with it. Okay. Peter Thiel, an early investor in Bitcoin, made a fortune off of Bitcoin, said at the Aspen Ideas Festival last week that he thinks it's done. It's fully valued. The ETF story is played out. The halving story is played out. There's no more incremental investors, and Bitcoin is sort of done. Not that it's going to go down, but it's sort of going to plateau in value here. How would you respond to that?
I guess it's easy to say when you've caught the initial wave. And by the way, I wouldn't suggest people invest in Bitcoin because they think it's going to go up another 10,000%. I think that's silly. I haven't seen his full comments, but I'd counter that with, You've got really, really smart macro and macro guys like Bob Elliott on Twitter talking about re-rating neutral inflation expectations from historical 2% to 4.5%, 5%. What does that do for risk assets like Bitcoin? You know, do you think we're moving into an era of increased stability on this planet, political or otherwise? No, I don't. We haven't even know.
So unfortunately, no time soon. I don't see an era of, I mean, it's just terrible to say, but it's just not anytime soon.
Yeah. So what I respond to is that that analysis sounds like the analysis we hear every 4 to 5 years about crude oil. If you want to laugh, Google Forbes. I think it's Forbes or Fortune magazine covers about crude oil for the last 30 years. Every 2 or 3 years, they do a cover saying we're awash in crude oil. Crude oil is going to zero. And then 3 years later, there's the same cover, except it's a desert. We have no more crude oil. It's going up forever.
Right.
So that's the nature of these commodities.
They do that a lot, unfortunately. I'm just trying to understand that. I mean, they did that to us in the 80s. They told us that we were running out of oil. They said it was peak oil theory. We were running out of oil. And then, of course, we didn't run out of oil. You know what I mean?
Yeah. So these scarce, essential assets. And again, it depends on if you believe. I believe Bitcoin is a scarce, essential asset. I think if you live in a part of the world where the government could just break down your door, hang you up at a hotel, beat you until you give you their money, having an immutable, storable, fungible store of value is scarce and rare, scarce and valuable. And if you believe that, then we'll go through these peaks and valleys, but the long-term pressure should be consistently up. Now, if his argument is we're not going to have another 10,000% appreciation, we can have a discussion about that. I don't know how I feel about that, but to argue it's done, that's a bit of an entitled argument. I think that it's maybe done for you, but I don't think it's done for all the parts of the world that need it.
This week, we also put together a new video on how to purchase T-bills directly from the Treasury Direct website. So if buying T-bills is something you're interested in, this should give you the tools to do so. This is a quick video as part of our Wealthion Academy on how to buy very short-dated U.S. Treasuries, known as T-bills, directly from the U.S. Treasury using the Treasury Direct website. T-bills are offering yields around 5%. Investors who are concerned about the volatility of today's financial markets, you have somewhere safe to park capital, keep it relatively liquid, and get paid a decent return on it. Until recently, T-bill yields has been at record lows for much of the past decade, down near 0% for many years. You can see from the chart, the last time they were this high was 2006. And with the inflation rate as measured by CPI falling, T-bills offer a positive real return when adjusted for inflation. I can't tell you how many times we've had viewers, investors say, I'm too spooked by the turbulence of today's uncertain markets. If I could just find a safe place to get 4 to 5% return on my money for the time being, I'd be thrilled. Well, that's possible given where short-term yields are. T-bills are particularly attractive option right now for folks with cash sitting in bank or money market accounts. According to Bankrate, as of the filming of this video, the national average yield for savings account is just 0.58%. It's pretty awful and low. While the Fed has raised the federal funds rate faster than at any time in history over the past year, most banks haven't followed suit. They've been reluctant to raise their yields on savings accounts, money market accounts, and CDs. Even though the Fed dramatically increased the interest rates that banks receive on excess reserves, they're just keeping the difference to themselves rather than sharing it with depositors. Not exactly fair since you're depositing your money in their bank, but as the saying goes, sometimes life isn't fair. And while you can find some banks, mostly online ones, offering generous rates, they're right around what T-bills are offering right now. But those rates will go down as soon as the Fed starts to cut rates. And those lower rates also come with counterparty risk, greater than that of owning a T-bill. So we here at Wealthion are going to show you how to purchase T-bills directly from the Treasury Direct website. The same process can be used to buy longer duration U.S. Treasuries, notes, and bonds also, but this Wealthion Academy video will be geared toward the short-term Treasury bill. You can also buy and sell T-bills through a brokerage account, but there could be other fees involved that you don't pay on the Treasury Direct website. There are differences between using Treasury Direct versus brokerage platforms to transact and with T-bills. In short, Treasury Direct gives you more options when purchasing them, and brokerage accounts are more convenient when it comes to selling. But for most people, selling doesn't come into play very much because of the short duration that T-bills have. In most cases, you just let the T-bills mature and get your full principal back at the end. As a quick rule of thumb, using Treasury Direct makes sense when you've got cash in the bank and you want to earn a better return. I'll show you how to link your bank account to the Treasury Direct website. And once that's done, the Treasury will put the funds from your bank account to buy the T-bills and then deposit the full amount back into the same bank account or another account of your choosing on the date that the bill matures. If you have cash already in a brokerage account, you want to buy Treasuries with them, it probably just makes more sense to buy the bills through your broker. Thank you for watching this week's recap. Don't forget to head over to Wealthion.com for a free, no-obligation portfolio review with one of our registered investment advisors. And please follow us on social media for the latest news and information to help you invest wisely. If you haven't done so already, please make sure to like and subscribe to our channel, and don't forget to hit the notifications bell so that you never miss a video. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish. If you like this content and looking for more ways to keep growing your investments, watch this video next.